Most beginner traders turn their first $1,000 into $0 in the first 3 seconds of being in the futures market. If you don't want to be a culprit, just give me 2 minutes of your time. Let's understand the common terms used in futures trading and how they can affect your all account balance in futures. And this is going to help you know why 95% of the beginners in the futures markets lose their money and end up quitting. Grab your pen and paper. Class is in progress. Let's go. Number one, what is futures trading? Futures trading is the art of predicting that prices will either go up or down. That means you're trading according to predetermined prices. And if the prices go in your direction, you make money. If they go against you, you lose money. Then the other term is long. When we say we long the market, we mean we predict that the market is going to go up. When we say short the market, we predict that the market is going to go down. So yeah, that is it. And then leverage. This is the borrowed money that you use to amplify your trading positions. And you know the disadvantage with leverage is the fact that it amplifies both your losses and profits. For example, if I have $10 and I use 10x leverage, that means I can run a position of $100. That's the beauty of leverage. You increase your capital, increase your profits. Then we have what we call funding rate. These are the periodic fees that are paid between buyers and sellers. They are not paid to the exchange, they are paid from buyers to sellers. Sometimes the longs will pay shorts and sometimes shorts will pay longs. Why the funding rate? To ensure that the price of the futures contracts matches or balances with the price of the spot signals or the spot coin. Yeah, that is the funding rate. And it's very important because it ensures that the prices match and there is no manipulation in the market. Then we have what we call initial margin. This is the minimum amount required for you to open a trading position in the futures markets. Then we have what we call the maintenance margin. With a maintenance margin, this is the minimum amount of money that is required to maintain an open position. And this takes us to what is called margin modes. So margin modes determines how your collateral is protected. We have what we call the cross mode. With a cross mode, all the available capital in your exchange is used to run the open positions, whether they are 5, 1, or 2, and you have $1,000. That $1,000 is assigned to all the open positions. If one position goes against you, you lose all the money at once because they are sharing capital. So cross mode is good because it aims at protecting your position for a long time. But when it gets to the downside, you may end up losing all your capital at once. With the isolated mode, it is the mode whereby only the assigned capital is the one that is used to run that particular open position. For example, if I say I'm giving this trade $50, if those $50 expire, the trade is going to go in what we call a liquidation. And I'm going to lose only that $50. My other balance in the account is not going to be affected. So what is liquidation? Liquidation is when your position is forcefully closed because your maintenance margin is no longer enough to keep the position running. And before liquidation happens, a margin call is sent to you. So dear RoyalQ users, don't confuse this with the dollar costing we use in RoyalQ. A margin call in futures trading, that is the urgent warning the exchange sends you to let you know that you're running out of cash on your exchange. So you either have to go and close the position first before it is forcefully closed by the exchange, or you add more collateral or capital so that you keep the position running. So margin call in futures, it is an urgent warning to go check what is happening to your trade before your money is forcefully taken through liquidations. That is margin call for you. Then we have position size or position amount or fast buying amount for people using the RoyalQ software. This is the total dollar value of your open position. It includes your cash, that is your margin, and also your leverage. So to get your position size, that means you're going to multiply your risk amount. The risk amount is the amount of money you're willing to lose on a trade times your leverage. For example, if I'm willing to risk $50 on a trade and I'm using 50x leverage, that means I'm going to open a position of 2,500x. $2,500. that is your position size, 2,500, the leverage, and the risk amount, that is the money you can lose on a particular trade. Then we have what we call the risk to reward ratio. This is a comparison of how much you can win in a trade and how much you can lose in a trade if it goes against you. And in most cases, we say 1 to 3. You're going to risk less and win more. So with a risk to reward ratio, it means that if I'm using, for example, 1 to 3, it means I'm risking, for example, $1 to make $3. So that means my risk amount will be $1. That is the amount of money I'm willing to lose, and I want to make $3 if I risk that $1. Then we have what we call the mark price. In sports markets, we have current price and average price. In futures, we have mark price. This is the real-time value of the asset. And this is also used in calculating the liquidation price, the price at which your position is forcefully closed. And this mark price keeps on changing as the price of the open position or the open coin changes. In brief terms, mark price is the estimated real-time value of the coin or the futures contract. Then we have profit and loss of P&L. This is the financial results of an open or closed position. If it is realized profit, that is the profit you've made or the loss you've made. If it is unrealized P&L, that is the profit or loss you have not yet made. Then we have what we call open interest in futures trading. This is the total number of open positions in the futures market across different exchanges. And those contracts haven't been settled yet. Open interest, open contracts. Then we have what we call index price. Index price is the average real-time spot price of the coin across several major exchanges. That is why manipulation of the crypto futures is hard, because the price is compared across major exchanges to get the mark price. And finally, we have hedging, stop loss, and take profit. Hedging is opening two positions at the same time to protect one. For example, you've opened a long position and you feel like the market is going against you. You can open a short position. So it's running two positions of one asset at the same time. Take profit, that is the predicted profit you want to get from the market. And stop loss is an automatic order for the market to close when a certain price is reached to cut losses. Before I forget, we also have what we call perpetual contracts and delivery contracts. Perpetual contracts do not have an expiry date, but once the agreed term is met, they are closed. With delivery contracts, they run within a specific period of time. Once that period reaches, they expire. Happy trading. Don't forget to follow for day 3 of understanding the futures market. Lots of love. Bye.